Welcome back to Talk Tickers. This is the deep dive where we strip away all the press release fluff, ignore the corporate PR, and get right down to the mechanics of the earnings calls that are moving markets.
And I'm here to dig into the numbers, the guidance, and maybe the stuff they tried to bury in the footnotes.
Today, we are looking at a ticker that has, it's effectively defied gravity in the last 24 hours. We're talking about General Motors.
Yeah.
If you were watching the tape, you saw the story. GM stock absolutely ripped to record highs, closing over $86. That's an almost 9% move in a single day for a massive legacy automaker.
It's a huge move. And, usually when you see a legacy company pop like that, you assume they just posted the cleanest, most profitable quarter in their history. You expect perfection.
That is exactly the hook for today, because if you just glanced at the headline number, the cap net income, it looked like a complete disaster.
Oh, total mess.
A massive loss, red ink everywhere. But the street just completely ignored it. They looked right past that scary number and started buying.
It's that classic disconnect, right?
Yeah.
And it confuses so many investors. The company technically loses billions on paper, but the market treats it like a victory lap. So our mission here is to really unpack why.
Right. We need to break down the real numbers versus the noise, this big pivot in their EV strategy and the plan to dodge these tariff headwinds everyone's worried about.
Absolutely.
So let's start with the report card. What actually happened in Q4? Give us the snapshot.
Okay, here's the split, and this is crucial. On an adjusted earnings per share basis, and that's the number Wall Street really cares about, GM posted $2.51.
And the street was looking for what?
They wanted $2.26. So that's an 11% beat, a solid double-digit beat on the bottom line.
Okay, a solid beat. But the top line, the actual revenue from selling cars, that wasn't quite as good, was it?
Yeah. No, it wasn't. Revenue came in at $45.3 billion, let's say. The street wanted closer to 46. And it was actually down about 5% year over year.
Okay, so let's pause there. A slight revenue miss, a solid earnings beat. I mean, that usually gets you a polite nod from the market, maybe a 1% bump.
Exactly.
It definitely does not get you a 9% rocket ship to all-time highs. So we have to talk about the elephant in the room. That GAAP net loss, negative $3.3 billion.
Right. It's a huge, ugly red number.
So for anyone listening who isn't a forensic accountant, what's the difference here? Why is the gap between the real number and the story number over $3 billion wide?
This is where it gets fascinating. And honestly, it's the art of being a CFO. That loss was driven by over $7 billion in special charges.
Yes, $7 billion.
What management was doing is what we call a kitchen sink quarter.
A kitchen sink quarter, that sounds messy.
It's a strategic mess. You know the phrase, throwing everything in but the kitchen sink. If you know you have to pivot, you take all your losses at once, you write down factories, you pay off suppliers, you impair assets, you take all the pain in one lump sum so the future looks clean.
So they basically took every bad decision related to their EV push, wrapped it up and said, okay, we paid for it, done.
That's exactly it. Massive write-downs tied to right-sizing their EV capacity. They even paid out commercial claims to suppliers because they aren't building as many EVs as they promised.
I think people miss that detail. They paid suppliers not to build parts.
Correct. I mean, think about it. GM promises to buy 1 million widgets from a supplier. If they only buy 100,000, they owe a penalty. GM decided it was cheaper to pay those penalties now than to keep building unprofitable EVs.
And investors love that.
They loved it because it signals discipline. It shows management isn't throwing good money after bad. They admitted the strategy wasn't working, paid the exit fee, and moved on.
So the loss wasn't an operational failure, it was a strategic reset.
Precisely. And once you strip that out, the underlying business is just printing money. And that brings us to the real reason the stock is at $86. It's the cash.
The capital return program, I saw the numbers and they looked huge.
It is a monster. First, they hiked the dividend by 20% to 18 cents a quarter. That's nice. It keeps the income investors happy.
But that's not the main event.
No, the heavy artillery is the buybacks. The board authorized a new $6 billion share repurchase program.
$6 billion is a big headline number. But we see companies authorize these things all the time and then never actually spend the money. How serious are they?
This, for me, is the stat of the day. The CFO, Paul Jacobson, he noted that since November 2023, GM has reduced its share count by nearly 35%.
Wait, hold on. 35% in just over 2 years.
Nearly 35%. Think about that math. Imagine the company is a pizza with 10 slices. If you're a shareholder, you own one slice. GM has bought back 3.5 of those slices and just thrown them away.
So my one slice is now a much bigger piece of the remaining pizza.
Exactly. The remaining slices get bigger. So even if the company's total profit stays completely flat, your earnings per share goes up by 35%, just because there are fewer shares.
That is some serious financial engineering.
And by authorizing another $6 billion, they're sending a loud signal, we think our stock is still cheap. They're putting a floor under the price.
Okay, so they've cleaned up the books, they're buying back stock like crazy, but what about this pivot back to internal combustion engines, ICE? Is this a retreat? Are they admitting defeat to Tesla?
I wouldn't call it defeat, I'd call it adaptation. The theme of the call was realism. Mary Barra was very explicit about adapting to tax and trade policy changes. The strategy has shifted from EV volume to EV profitability.
Right sizing was the word they used over and over.
It was. They're pivoting assembly from EVs back to ICE where the demand is actually strong. And here's the key. They claim EV losses will be lower going forward because they've resolved most of those supplier claims.
So the bleeding on the electric side stops.
The bleeding stops. And the cash cow, the trucks and SUVs, keeps funding everything else. They guided North America margins to return to the 8 to 10% range in 2026.
That is a very healthy margin for an automaker, isn't it?
It's very impressive. Mass market auto is usually a low margin grind. 8 to 10% is strong.
But how do they maintain that when everyone's worried about a recession? I mean, cars are expensive.
Inventory discipline. This is the new GM. They ended the year with 48 days of dealer inventory. Their target is 50 to 60.
So they're running lean.
Very lean. And that's good for pricing. When inventory is scarce, you don't have to slap massive incentives on the hood to move metal. They're keeping supply just below demand.
Okay, so a leaner, meaner GM. Let's look at the guidance. What are they promising for 2026?
The guidance was very strong. I think this is what really solidified the rally. They're guiding for EBIT-adjusted of $13 to $15 billion.
And for EPS?
$11 to $13. The midpoint of that is a little above where the street was.
What about cash flow? You can't pay dividends with adjusted earnings.
Adjusted automotive free cash flow is expected to be between $9 and $11 billion. That's a massive amount of cash generation. It basically signals that all those fears of peak auto were overblown.
But speaking of headwinds, we have to talk about tariffs. How bad is the hit for GM?
It's significant, but their message was manageable. They flagged $3 to $4 billion in gross tariff costs for 2026.
3 to 4 billion? That's not pocket change. That wipes out a huge chunk of profit.
If you take it at face value, yes. But the CFO highlighted what they call self-help measures.
Self-help? What does that mean in manufacturing?
It's corporate speak for fixing your own problems.
Yeah.
It means supply chain shifts, moving parts, sourcing from one country to another to avoid the tariff. It's changing your manufacturing footprint.
So they're rerouting the supply chain in real time.
Effectively. And they claim the net tariff impact will actually be lower in 2026 than in 2025 because of these mitigations.
That is pretty agile for a company people think of as a dinosaur. Now, here's something I want to dig into. Everyone looks at GM as a metal-bending company, but there was a lot of talk about software and services. Is this actually material, or is it just tech washing?
It is becoming very material. They aren't just selling cars, they're monetizing the fleet.
Yeah.
Mary Barra highlighted OnStar has a record 12 million subscribers. That's recurring revenue.
12 million. That's the size of a decent streaming service.
Exactly. And then you look at Super Cruise, their hands-free driving tech. About 620,000 subscribers, and that grew 80% year over year. They're projecting deferred revenue from software to hit $7.5 billion by the end of 2026.
Okay, pause there. Deferred revenue. Translate that for us. Why is that number so important?
Deferred revenue is basically cash you've already collected but haven't earned on the books yet. Think of it like a yearly subscription. A growing deferred revenue pile is like a crystal ball. It tells you that high-margin cash is guaranteed to hit your income statement in the future.
So they have billions of dollars of high-margin software revenue just sitting in the waiting room.
Exactly. But there's another hidden gem. GM Financial received approval for an industrial bank charter.
An industrial bank charter? Why does a car company need to be a bank?
This is huge.
Yeah.
Previously, GM Financial had to borrow from the bond market to lend to car buyers. Now, with a bank charter, they can take deposits.
Like a savings account. I could open a GM checking account.
Potentially, yes. And deposits are much, much cheaper than corporate bonds. So if you can lower your cost of funds, you increase your margin on every single car loan. It's a massive structural advantage.
So they've got software margins kicking in and a bank to finance the metal cheaply. It's really starting to sound less like a legacy trap.
That's the whole narrative shift. For years, the market saw GM as a dinosaur. Now it's starting to be viewed as a cash compounder.
So let's look at the investor reaction. Stock closed at 86.38, volume was heavy, but the options market.
Oh, it was a frenzy. We saw massive call buying, specifically the weekly $85 and $88 strikes. The options market was betting on an immediate breakout. This was a violent repricing of the asset.
It feels like the market has stopped asking when will GM die and started asking how much cash can this thing generate.
The divergence between that huge GAAP loss and the stock rally is the signal. Investors are rewarding capital discipline over blind growth.
It's a lesson in free cash flow, isn't it?
It really is. The old guard showing the new kids how it's done.
Okay, we've covered the numbers, the strategy, the pivot. Now it's time for our favorite segment. We're going to put our hedge fund hats on.
I love this part.
Standard disclaimer first. This is not financial advice. We're two voices on a deep dive, not your advisors. This is for entertainment only.
Seriously, do your own diligence. Don't trade based on what we say. We're just gaming out the thesis.
Okay, here's the pitch. I'm calling this one the robot Rust Belt Squeeze.
The robot Rust Belt Squeeze. Okay, I'm listening. What's the setup?
The setup is that the market is still mispricing the tech inside GM. Everyone's looking at the sheet metal. Nobody's looking at that deferred revenue stack hitting $7.5 billion. Nobody's properly valuing the tariff mitigation.
So what's the trade?
It's a long-short pair. You go long GM. You're betting on that $6 billion buyback as your safety net. Management is literally telling you they will buy the dip, but you're also betting on a multiple expansion, you know? You stop valuing it at 5 times earnings like a car company and start creeping up to 8 or 10 times.
Okay, long GM, what are we shorting against it?
Short the pure play EV competitors, the ones who don't have a massive ICE cash cow to offset tariff costs, the ones who don't have a $6 billion buyback to support their stock when things get shaky.
That is ruthless. You're betting on the incumbent using its cash pile to basically outlast the disruptors.
That's exactly it. In this trade, GM isn't an auto stock anymore. It's a bank attached to a software company wrapped in a dividend-paying sheet metal factory. We ride the options momentum on those $88 calls until the buyback machine runs dry.
It's a bold call. But looking at this report, the data supports it. If the tariff war heats up, who survives? The company with $21 billion in cash and profitable trucks, or the one losing money on every car they sell?
It's a flight to safety, but safety happens to be a company growing EPS by double digits.
They cleared the decks, they took the pain, and now they're just printing cash.
So what does this all mean for you listening right now? GM cleared the decks on all the bad news. They hiked the dividend, they promised 8 to 10% margins, and the stock hit record highs.
The takeaway here is that execution matters. Narratives are great, but in this market, free cash flow is king. And GM just proved that.
The old guard taught the market a lesson. And here's something to chew on before we go. If GM is effectively becoming a bank with the software division, at what point does it stop trading like a car company entirely?
That is the trillion-dollar question, isn't it?
Keep your eyes on the ticker. Talk Ticker's out.